Hey everyone, and welcome. So let's talk about something you've probably heard thrown around a ton, mutual funds. We're gonna break it all down, what they are, how they work, and, why they might just be a super important tool for your financial future.
All right, let's just jump right in with a tough question. Is your money actually losing value while you sleep? I mean, if your savings are just chilling in a bank account, the answer is probably yes. See, in a country like India, inflation is typically chugging along at around 4 to 5% a year. And what that really means is your money's buying power, it's slowly but surely shrinking, day after day.
So what can you do instead of just letting your money sit there? Well, let's look at the usual suspects. A savings account, it'll get you about 4%, which, like we just said, is barely even keeping your head above water with inflation. A fixed deposit, or FD, yeah, that's better, maybe 7-8%, but the catch is your money is locked up tight. And gold, it can be all over the place, super unpredictable since about 2012. And then there's real estate, which is great, but you need a huge amount of cash just to get in the game. For most of us, each of these has a pretty big roadblock.
Okay, so what about just buying stocks directly? Well, that's got its own hurdle. Let's say you want to buy just one single share of 3 of the big guys. You'd be looking at over 9,000 rupees. For a lot of people just starting out, that's a really high price for entry.
So, how do we get around that high barrier? The solution is actually pretty simple. It's all about pooling your money. Just think about it, like you and a few friends wanting to order a giant pizza. Instead of one person footing the whole bill, you all chip in. Same idea here. If you and 4 friends each put in 2,000 rupees, boom, you've got the 10,000 you need for that big investment. This idea of pooling money together, that's the absolute core of what we're talking about.
But, that informal let's pool money with friends thing has some pretty big flaws. I mean, what if the friend holding the cash makes a really bad decision? Or worse, what if they just disappear with it? There's no transparency, and the risk of someone defaulting is super high. This is exactly why we need a proper professional system.
And that right there is where the mutual fund comes in. It's the modern, structured, and this is the key part, the regulated way to invest together.
The whole concept is literally in the name itself. Mutual means it's our fund. It's a collective pot of money from tons of investors, people just like you and me. And that fund, well, it's handed over to a professional who then goes and invests it in a whole bunch of different things. It's basically teamwork, but for your money.
Okay, so how does this whole thing actually work under the hood? Who are the main players, and what's stopping them from just running off with your cash? Let's get into the mechanics.
So here's what's really cool about the system. It's built with all these checks and balances to protect you. First, there's you, the investor, providing the money. You give it to an asset management company or AMC. Think of them as the experts managing the fund. But here's the thing, they can't just do whatever they want. There's a separate trustee whose only job is to make sure the AMC is acting in your best interest and watching over all of it. You've got CB, the government regulator, acting like the ultimate referee. It's a really well thought out, regulated machine.
Right, so not all mutual funds are created equal. They actually come in a bunch of different flavors, each one designed for different goals and, importantly, different comfort levels with risk. This chart pretty much sums up the basic trade-off in all of investing. Down on the bottom left, you've got debt funds. These are lower risk, which usually means more stable but lower returns. Then way up on the top right, you have equity funds. These guys carry higher risk, but they also have the potential for much, much higher returns. And smack dab in the middle, that's where hybrid funds live, trying to give you a bit of both.
So let's take a closer look at equity funds. The idea here is really simple. They take all that pooled money and invest it directly into the stock market. Now, because the market goes up and down, they're definitely riskier, but that's also where you find the biggest potential for your money to grow over the long term. Debt funds, on the other hand, are a whole different ballgame. They're much safer. With these, your money is basically being loaned out to governments or big companies, and in return, you get interest payments. A good way to think of it is like a more flexible version of a fixed deposit, maybe with slightly better returns. And finally, we've got hybrid funds, which, you guessed it, are a mix of both. This chart here shows a classic example. You can see the bigger slice, maybe 70%, is in those safer debt instruments, but the other 30%? That's in stocks, aiming for a bit of that growth. It's all about finding that perfect balance that lets you sleep at night. Okay, before we pull back and look at the big picture, we gotta quickly translate some of the jargon you'll hear, but don't worry, I promise it's not complicated. These 3 terms are pretty much all you need to know to get started.
First up is NAV, which stands for Net Asset Value. Now, I know that sounds super technical, but don't let the name scare you. All it means is the price of one single unit of a mutual fund. That's it. Just like a stock has a price per share, a mutual fund has a price per unit, it's NAV. And that price gets updated every single day. Next up, TER, or the total expense ratio. This is just the small annual fee you pay the fund manager, the AMC, for all their hard work. You know, for doing all the research, making the investment decisions, and handling the admin stuff. It's usually a really small percentage of your investment, somewhere between 0.05% and 2.5% a year. And the last one is the exit load. Think of this as a penalty for cashing out too early. It's a small fee, usually about 1%, that you might have to pay if you pull your money out too soon, typically within the first year. It's really just there to encourage people to think long-term instead of panic selling every time the market gets a little shaky. All right, now that we've got the lingo down, let's zoom out and put it all together. It's time to look at the big picture, the main pros and cons of investing in mutual funds.
So let's lay it all out. On one hand, the advantages are really powerful. You get instant diversification, which is huge. You have professionals managing your money for you, and it's super affordable. You can often get started with just a small, regular investment. But on the other side of the coin, your returns aren't guaranteed, right? They're tied to the market. You do have to pay those small fees we talked about, and you don't get to pick the individual stocks and bonds yourself. You're handing that control over to the expert.
But let's just double click on that first advantage for a second, because diversification really is the superpower of mutual funds. I mean, think about it. By spreading your money across tons of different investments, you're building in this incredible safety net. It's just highly, highly unlikely that the stock market, gold, and real estate are all going to have a terrible year at the exact same time. And that really brings us to the end of our little tour. You now have the basic building blocks to understand what a mutual fund is and how it all works. So the question on the screen isn't really for me to answer, it's for you to think about. With this new knowledge, what's the right next step for your financial journey? Thanks so much for tuning in.